For a lot of small business owners, the S corporation feels like the holy grail, right? You get that awesome liability protection, but you get to skip the double taxation of a C Corp. But here's the thing. Baked right into that structure is this massive temptation. It's something that can turn what feels like a smart tax move into a huge, costly liability. So today, we are going deep on this critical issue of S-Corp salaries. Specifically, what happens when the IRS looks at your return and sees a big fat zero on your payroll line. All right, let's just cut right to the chase. This is the one question every single active S-Corp owner has to ask themselves. Can I legally pay myself absolutely nothing in salary and just take all the company profits as distributions to save a bundle on taxes? Well, the short answer is a hard no. And today we're going to dissect exactly why that high-risk play is basically a VIP invitation for an IRS audit. So here's our roadmap. We'll start with why the S-Corp structure itself creates this temptation in the first place. Then we'll get into the nitty-gritty, the actual laws the IRS uses to come after you. We'll show you how they spot this on your tax return and figure out what reasonable compensation even means. And of course, we'll cover the pretty severe fallout of getting this wrong and, most importantly, how to do it right and stay off the IRS's radar. Okay, first up, the S-Corp compensation conundrum. To really get why this is such a common tripwire, you have to understand this unique tension that's just built into the subchapter S tax structure. It puts two things in direct conflict: how you get paid for the work you do and how you get paid for the business you own. See, as an S-Corp owner, money can come to you in two totally different ways, and the taxman treats them very, very differently. First, you have W-2 wages. That's your paycheck for being an employee, for doing the actual work. And that paycheck, it's subject to FICA and FUTA payroll taxes. Then you have S-Corp distributions. Think of that as your share of the profits for being the owner. And those distributions are not subject to payroll taxes. That one little difference? Well, that's where all the trouble starts. The whole incentive to play games here boils down to one simple number: 15.3%. That's the FICA tax wedge, Social Security and Medicare. By calling a payment a distribution instead of wages, you're trying to dodge that entire 15.3% tax hit. I mean, think about it. On $100,000, that's more than $15,000 in your pocket instead of the government's. You can see why people are so tempted to try it. And that temptation leads directly to what's known as the zero payroll strategy. This is where an owner who's busting their tail working in the business pays themselves zero, zilch, in W-2 salary, but pulls out, let's say, $100,000 in distributions. Now, let's be perfectly clear on this. The IRS does not think this is clever tax planning. They have a different term for it: tax evasion. To them, you're intentionally undermining the system that funds Social Security and Medicare. So you might be wondering, okay, but how can the IRS actually enforce this? Well, their authority isn't just some vague guideline. It is rooted in very specific sections of the Internal Revenue Code, and it's been backed up again and again by decades of court rulings. This is the legal firepower they bring to every single audit. The whole thing starts with Internal Revenue Code Section 162A1. Now, what's fascinating is that historically, the IRS used this against C-Corps to argue their executive salaries were too high. But for S-Corps, they just flip the script. They use the same rule as a sword. Their logic is kind of brilliant and simple. The code allows a deduction for a reasonable salary for services rendered. So if you rendered services, a salary must be paid. To not pay one is to misrepresent the economic reality of the business. Then you've got this really pivotal ruling, Revenue Ruling 59221. This is the rule that actually gives S-Corp distributions that amazing tax break, exempting them from self-employment tax. But, and this is a huge but, there's a catch. The whole foundation of that ruling assumes the shareholder is also an employee getting a W-2 for their work. So when you take a $0 salary, you're taking the sweet part of the deal without holding up your end of the bargain, which is paying FICA tax on your labor. And all of this really hinges on a core legal principle you've got to understand: substance over form. Basically, the courts have said time and time again, we don't care what you call it. You can label a payment a dividend, a distribution, a special payment, whatever. If it looks like a wage, smells like a wage, and feels like a wage, guess what? For tax purposes, it's a wage. The substance is all that matters. Now, this brings us to what is probably the most famous case on this subject: Radtke versus the United States. So Mr. Radtke was an attorney and the sole employee of his S-Corp. He paid himself zero salary, but took about $18,000 in what he labeled dividends. His argument was, hey, that's just a return on my investment. Well, the court completely rejected it. In fact, they called his argument an economic absurdity. They pointed out that since all the company's income came directly from his labor, the payments were obviously wages. This one case pretty much slammed the door on the zero salary strategy for any S-Corp owner who actually works in their business. Okay, so you're thinking, fine, zero is bad. What if I just pay myself a little salary? Well, that's where the case of Watson v. United States comes into play. Mr. Watson, a CPA, no less, paid himself a salary of $24,000, not zero, but he was also taking over $200,000 a year in distributions. The IRS looked at that and said, no way. They calculated the real market value of his work was over $91,000, and the court agreed. The lesson from Watson is huge. Just paying some salary isn't enough to protect you. It's not a safe harbor. The amount has to actually be reasonable. So we've laid out the legal case against this strategy, but how does the IRS actually catch you, in the real world? The truth is, they don't need to hire a private investigator. You give them all the evidence they need right on the tax return you file every year. Form 1120S. It's an inescapable paper trail. IRS computers are programmed to look for a very simple three-part trap. First, their algorithm scans line 7, compensation of officers. If it sees a 0 there, boom, red flag number 1 goes up. Next, it looks down at line 21, ordinary business income. If that number is high, it creates a logical paradox. Wait a minute, how did this company make all this profit with zero paid labor? Then, for the final nail in the coffin, it checks Schedule K for distributions. If that number is also high, the trap is sprung. It proves the money was there, and it proves you chose to pay it out in a way that avoids payroll tax. It's game over. All right, so we've established the risk, we know how the IRS flags it. That leads to the million-dollar question. What in the world is a reasonable salary? This is where we need to shift gears from the problem to the solution. You absolutely have to have a defensible method for coming up with your salary figure. Now, the IRS isn't going to give you a simple formula or a magic percentage. That would be too easy. Instead, what they use is a multi-factor test based on all the facts and circumstances. They're going to look at your resume, your qualifications, your experience. They'll analyze the work you actually do. Are you the CEO, the janitor, and the lead salesperson all rolled into one? They'll look at the size of your business, what similar jobs pay in your area. It's a whole picture, not just one number. So to meet this test, you need a methodology. Professionals typically use one of 3 approaches. The one you see most often for small businesses is the cost approach. It's a simple question. What would it cost me to hire somebody off the street to do everything that I do? Another one is the market approach, which looks at salary data for similar jobs in similar companies. The point is to use a real, objective method to land on a number you can actually defend in an audit. But let's say you just roll the dice. Ignore all this and get caught. What actually happens? Well, the consequences are anything but trivial. It is a cascade of penalties and back taxes that can honestly be devastating, especially for a small business. This is the reckoning. Let's make this super concrete. Here's a real-world example. The IRS audited an S-Corp and reclassified just $45,000 of distributions into wages. The result? First, there was about $6,900 in back payroll taxes. Then they tacked on penalties and interest. The total bill was over $9,000, and that's before you pay your accountant to deal with the headache of the audit itself. And here's why that bill gets so big so fast. It's not just about paying the back FICA taxes. Oh no, the IRS loves to stack penalties. You'll get hit with a failure to deposit penalty, a failure to file penalty for all those quarterly 941s you never filed. They might even throw on a 20% accuracy-related penalty for negligence. And the final insult? They charge interest on the whole ugly mess, going all the way back to when the tax was first due. It just snowballs. All right, enough of the doom and gloom. How do you actually avoid this nightmare scenario? Let's talk about the remedy. It really just comes down to a few simple best practices that treat your corporation like what it is, a real, separate legal entity. Here are the golden rules, the things you absolutely have to do. 1. Use a formal payroll system. Seriously, it makes your taxes get withheld and your 941s get filed. 2, and this is the big one, you must pay your reasonable compensation before you take any profit distributions. If the business has a tight month, you skip the distribution, not the salary. Got it?
And 3, pay yourself on a consistent schedule, like every month. This makes it look and feel like a real job, which is exactly what the IRS wants to see.
So let's wrap it all up with this final thought. The S-Corp is a fantastic tool, but that benefit comes with a non-negotiable requirement. You have to pay yourself a fair market wage for the labor you provide. It's not a loophole to be exploited. Honestly, the whole zero-salary strategy is a relic from a bygone era. In today's world of automated, data-driven audits, it is a guaranteed red flag. So you really have to look at your own numbers and ask, is my salary a defensible tax strategy? Or is it just an audit liability waiting to happen?